Hello and welcome to Common Stock Valuation Tutorial, Part 1, Regulatory Background. My name is Max Fonarov. I'm a principal of Sorbus Advisors, an independent firm specializing in valuations that support financial reporting and tax compliance. Our work includes valuations of common stock, financial instruments, portfolio valuations, and intangible assets. Common stock value is not something many private and especially startup companies are focused on. Typically, the first formal valuation of common shares are done for tax compliance purposes under Internal Revenue Code, Section 49A. Under Section 49A, a recipient of stock option or other stock-based compensation may incur tax liability in the year when the stock options are granted. The situation arises when stock option strike price is below fair market value of the underlying common share. Needless to say, stock option recipient has not received any cash to pay the tax, and stock options may expire worthless. In other words, the tax would be paid for nothing. To avoid this, companies commission a common stock valuation and have strike prices of the option equal underlying common share value. Valuation methodologies are diverse and rely on significant amount of loosely supportable professional judgment. Valuations for tax purposes may be reviewed by IRS and settled in courts if the disagreement arises. Internal Revenue Code, at the same time, has very little formal guidance on how to determine fair market value. And the practitioners in the field have to rely on fundamental understanding of valuation methodologies, as well as on some guidance that is created as a result of the tax law. At the same time, all those documents are not well organized, and it really becomes more of an art than science for a valuation professional to create the report that would be admissible in court or satisfactory for IRS purposes. Financial reporting world is quite different at the same time. Financial reporting is really concerned with measuring stock-based compensation, which needs to be recognized on financial statements. The field is not necessarily concerned with whether the common share value is higher or lower than the strike price. They just need to have accurate input for the calculation of that stock-based compensation. Obviously, the lower the common share price, the lower the stock-based compensation will be. Unlike tax environment, financial reporting world has a significant amount of formal guidance published by various authorities. FASB has significant publications that describe different methodologies and approaches and the situations where valuations need to be done for financial reporting purposes. At the same time, AACPA published a series of practice aids that help valuations of various assets and liabilities. Specifically, in the common stock environment, AACPA Practice Aid first published its guidance in 2005 and took users of those publications through a very detailed analysis of what methodologies can be and should be applied in different situations for valuation of common shares and other privately held securities. The update for that publication was published as a working draft in 2011. The document is a almost 200-page publication that takes readers through detailed methodologies, ways to support important assumptions, as well as a great number of very detailed examples that would cover most of the situations that arise in the valuation field. Not only there is a significant amount of guidance for financial reporting purposes, but also there is a level of consistent scrutiny that comes when those valuations are utilized for financial reporting purposes. When the company needs audited financials, they hire audit firms, and audit firms spend significant amount of time and effort scrutinizing and making sure that they're comfortable with value conclusions outlined in those valuation reports. So again, unlike tax valuations, the financial reporting valuations undergo consistent scrutiny and review, which certainly improves the quality of that valuation work and makes the numbers a lot more supportable for various purposes. The review and sign-off by audit firms is not a simple process, and it's certainly a difficult task on the part of audit firms to in some ways take responsibility for the accuracy and appropriateness of the valuation analysis. So the level of requirement that is associated with those types of reports is pretty high when the accounting firms have to review the work. Of course, the positive of that is not overall, not just the level of quality is a lot higher, but also this quality translates into more defendable valuation conclusions as it relates to a tax side of the equation. Most of the reports and most of the valuation analyses for common shares are done in accordance with ACPA guidance, which is financial reporting guidance for the most part. But the value conclusions are also used in a tax environment as well. Again, auditors are gatekeepers and really truly dictate the level of analysis that is required for this type of work. So, as I mentioned, the first time a company would typically run into the requirement of doing this fundamental and independent valuation of the common shares is when they have to do it for 409A purposes. Obviously, the financial reporting purposes and share-based compensation covered under ASC 718 and ASC 50550 is the next logical extension of that same valuation analysis. However, companies will quickly run into many other situations where the valuation numbers become important. Boards certainly look very carefully at those valuation analyses because they imply the value of the overall enterprise, and that valuation becomes relevant in the situations where the company is trying to raise new rounds of financing or being sold. Individual private transaction and company shares may also rely on those valuations, because in many cases that would be the only document that shows what the value of the particular common share might be. It's an important number because the work is done completely independently and supposed to supposed to be a true representation of what the value is. Another extension of that analysis is the adoption of those 409A reports by venture capital firms. We've seen in many cases venture capital firms utilize those 409A reports in order to assist their own financial reporting compliance. Under the fair value guidance in ASC 820, investment firms have to report their investment portfolios and fair value. And many cases 409A analysis may provide that shortcut. So as you can see, there are many instances where the report may come into play, may not immediately happen with the first valuation, but generally management should pay pretty close attention to having the document to be reliable and supportable so that it could be used in further operations. So with that, we'll finish with part 1 of the tutorial. Part 2 will cover valuation methodologies and how to come up with the values as those valuation methodologies are described in ACPA Practice Aid.